So today I'm going to be talking about, a video that I've seen this video, multiple of times. And I've suggested this video to a lot of traders as well, because I truly believe that, the more you know the truth, the more you start to put a lot of, rules around your trading, so that you can be able to become the trader that you want to become. But before I go into this video, I want to talk about the person in the video. His name is Anton Kreil. So Anton Kreil is a former Goldman Sachs trader, partner of the Institute of Trading. They call them the ITPM, a portfolio management firm. So the ITPM is a portfolio management firm. So this gentleman, Anton Kreil, used to be a trader in Goldman Sachs. But then now he's an ITPM. So yeah, without further ado, I'm going to share my screen. I'm going to share the screen from YouTube so that you guys will know the video that I'm about to, review and tell you why I love this video. If you can see that I'm sharing my screen right now, and what you can see right here is Anton Kreil annihilates retail, brokers and trading educators. Now, listen, I'm going to be honest with you guys for real. I myself, I am an educator. I've mentored so many different educators around the world. Some of them are private. Some of them are me working with, institutions and stuff like that. And one thing that I will tell you for sure, that it is very easy to manipulate people if you are not willing to really care about the individuals that you are teaching. You know that I have one movement, one statement when it comes to the mission or the vision. Is basically fix your mind, fix your life, fix your trading. Because there are so many things that no matter what you do, that is the way the system is made. You cannot do anything about that. You need to understand the system is like that, and you need to be willing and be ready to go to the next level, with the truth that you find. Past and multiple of these points that he made. This video is I really respect this video. It's a very powerful video to me. And I think that, as a retail trader, you need to be able to watch this video. And while you're watching it, I want you to open up your heart. Don't be that, proud. Don't act like you know everything. Just let this video talk to you, because I'm even uploading this video for the sake of the beginners that follow me, and those that think that trading is something that you just do because it's cool, or trading is something that you do because your friend is doing it. You need to be ready for the business. You need to be ready to understand what goes into this business before it becomes the structure that we know of. So I'm going to start from the part where he says avoiding all stupid things. Let's watch what he says from here. All right.
Filming today, because we're now going to stick this on YouTube and the whole world's going to see it.
And this is why you have to, if you've heard of this phrase, be woke. Okay. What you're going to get taught today, pretty much every retail trader will never, ever figure it out. And it's pretty simple, straightforward stuff. But most retail traders, the vast majority, will never figure it out. And even if they do, they've been on a journey where they've lost so much money to figure it out, it's now pointless. So here, we're literally saving you a lifetime of losses. Or if you figure it out after 10 years, a decade of losses. So this is really useful information. First thing you have to do when entering any industry whatsoever, if you were going to set up a new business, the first thing you would do is do an industry appraisal. Who are the winners? Who are the losers? How's the industry set up? What parameters can I operate in? How do I be successful? What mistakes do I need to avoid? If you were going into any industry, you would do that as a smart business person. Why would you not do it in trading? It's the first thing you have to do. And there's been some major trends in the last 30 years that really affect retail. And they're very important. They have significant consequences. The first one is how the market's set up. Who owns the exchanges? The exchanges is where all the business is cleared. Every time you press the button, the order goes down a pipe, through a broker, through an investment bank, to the exchange. Who owns all the exchanges? Well, there we have it. Intercontinental Exchange, ICE, own NYSE and Euronext. That's the majority of business in the market. The Chicago Mercantile Exchange owns the Chicago Board of Trade, NYMEX, and COMEX. So basically, we have a monopoly / duopoly. What does that mean? What do we think it means? Who does economics here? Monopolies. Do we like them? What's the negative of monopolies?
Of course, nobody likes a monopolistic.
Potentially. Pricing.
Right.
Pricing power and control. So we'll come back to that later. But the exchanges are now basically owned by a couple of companies. By having a monopoly, they can control the market if they want to. How the market is set up, how the players must operate. Who they incentivize. Parameters like this. We'll come on to it later again. Second, technology. Obviously, technology's played a major role in the last 30 years. First things first, infrastructure. Massively increased retail trader participation. 30 years ago, you'd be on the telephone, calling a broker and just accepting the price on the phone, whatever you got. What have you got now? Well, internet penetration, internet capability, speeds, very low power.
So if you have been following me, and I always tell you guys that when it comes to the reasons, when it comes to a lot of retail traders not making money, the majority of times, the reason actually even is mostly because of the easy access we have to these platforms. To these platforms, we have so much easy access to it that we think that all you have to do is to just put some lines and put some things, and then you just start to make money. So technology really does play an important role in what we are doing now. And it's because I really want you guys to understand that every single thing that you'll be learning from either my platform, either from anyone, you just need to understand that it is all the structure, and you will get to understand every single thing.
Very low barriers to entry. Everyone can trade from their bedroom or their phone. Very easy access. Is that necessarily a good thing?
Not really, right? You remember I was making a joke. I was not being sarcastic. I was just being honest. I told you guys on one of our events, and I said, some people will just be in their bed and chilling, watching Netflix, and be like, man, I feel like gold is going to drop. And because of that, they just want to sell gold. This is a business. You need to respect it. Or you don't go to the toilet and you are just bored and you just, you want to use a washroom, whatever it is, you just want to use a washroom, and then you decide to just put a trade in because you feel like it's going to drop, it's going to go up. That is not how it works. You know what I mean? Yeah.
If you have access, does it mean you're good? Of course not. Hardware, microchips, processing speeds, massively increased. And then that's affected the penetration of retail traders, much lower cost of production. Again, lower barriers to entry. Software, connectivity to financial markets, and everything being organized for you. So making life easier. None of it actually means that the trader's going to be profitable. It just means you're supposed to have better access and better capability. It's supposed to help you more, but it doesn't necessarily mean you can make money. Regulators. Every problem we've had in the financial markets in the last 30 years, the regulator's done nothing to stop it before it's happened. It's always happened afterwards. The regulator is always passive and reactionary in pretty much every geography in the world. So in 2010, one of the main instruments that retail traders use are contracts for difference. They were banned in the United States. Why? Because too many people lost too much money too quickly. Also in 2010, IB contracts, which we'll come to later. Does anybody know what IB stands for? If you do, it means you're in the industry and you're on the brokerage side.
Introducing broker contract.
Introducing broker contract.
Yeah.
Are you a broker? Congratulations. You're not going to like this seminar. Okay. So IB stands for Introducing Broker. We'll go into the details on those later. But essentially it means that people introduce retail traders onto the broker's platform and get a kickback for doing so. They were banned in Singapore in 2010. Why do you think they were banned? Why do we think they were banned in Singapore? Because they're great? Conflict of interest.
Yeah.
Hit the nail on the head.
Right.
Loads of bad people were turning up into Singapore, like they do all over the world, and teaching people absolute nonsense, putting them on trading platforms, and everyone was blowing up and losing their money.
Right.
So the regulator, government, stepped in and banned them. And this is very typical of regulators. They do it after the event. So what does that mean if you're a retail trader? Well, history tells us, as a retail trader, you have to regulate yourself, because the regulator's not going to save you. They're passive, reactionary. You'll lose all your money. Then they might change a law afterwards. Doesn't matter. You're done. You're out the game. Financial markets volatility. Volatility in all the major asset classes since the financial crisis, so 08, 09, so from 09 onwards, has been crushed. What does that mean for traders? Sure. So volatility for traders is the lifeblood of a trader. A trader is a slave to volatility. Because without volatility, you don't have any risk and you don't have opportunity.
I want you to really listen to this part very well. It's very important that you understand this part. So the main reason why, I'm doing this video basically is just for the sake of those who follow me. And I want them to understand, because it's 2 hours video. And the majority of times when you tell people to consume a content, they don't, especially if they are the ones that found the content, they don't really have the passion to really consume the content and digest it. So I'm just doing this for the sake of those who follow me and those, who will listen to some couple of instructions and guidance that I will give. And I'm telling you that you should go and sit down and watch this video. You should watch this video, pay attention to this video. Make sure you have your book and your pen. Around my office, I'm always having my book around here with me. So it is very important that you are always, being intentional with the things you hear. I just really want to remind you so that you're watching this video with not just, double-minded trying to analyze what Anton is saying, because he's saying some powerful stuff.
And risk and opportunity are 2 sides of the same coin. It's called volatility. And if volatility gets crushed, risk and opportunities get crushed, which means returns over certain periods of time, over certain time horizons, peter to zero. So why is financial market volatility being crushed in all the asset classes? Well, the first main reason was the monetary policy after the financial crisis. So if you remember, the Fed was implementing QE, quantitative easing. What does that do? Guaranteed buyer of bonds, suppresses yields permanently. That feeds over into other asset classes because money keeps buying other asset classes to chase.
So I know that you guys are going to go back and watch these videos, but I'm pointing out something that is important. Let's go to the reality of the industry. Let's talk about that.
So retail broker incentive 2, provide third-party financing with no risk or very little risk, take a turn out the financing, and use the credit facility to encourage retail traders to trade as frequently as possible in the biggest size possible, and take the other side of all the trades. Not a bad business. And again, why are we looking at this? You need to understand the realities of the industry. Step 1. This is how it works. Step back for a second and think how long it takes you to open a trading account. Quite a few of you have opened trading accounts before. How long did it take you? Someone shout out. 10 minutes? What did you provide to open the account?
KYC data.
Passport.
Right.
Utility bill. So identify yourself. Utility bill. Confirm address. You are who you say you are. What else did you have to do? You'll sign some terms and conditions because they'll qualify you as someone who's got money.
Right.
Did you read the small print? Sure. And we're assuming everyone's non-professional. So in the terms and conditions, what are you actually doing when you sign them off? The only line that matters is one line, and it'll be in there somewhere. I'm happy to lose all my money. And the broker is not, it's not his fault. Broker's got nothing to do with it. It's a risk disclaimer. I'm happy to lose all my money. So that's all you do. Passport, utility bill, fill out the terms and conditions, sign it off. I'm happy to lose all my money. Then what happens? You've got a trading account. You've got access. A total stranger who's never met you is willing to lend you 100 times what you put in your trading account because you provided them a passport, a utility bill, and said, I'm happy to lose everything.
Okay. So so initially you are donating money. You know, so 90% of retail traders lose their money in 90 days. And that is not a funny sentence anymore because it's a reality. And so if you start and you are ignorant and you are just walking around, playing around, taking this industry as a joke, you are just donating your money. You are signing up to just give your money away.
Welcome to the world of retail trading.
Right.
But why are they doing that? Why is it so simple and straightforward? Well, think about the regulators. Passive, don't care. They react. Retail brokers, clearly with these conflicts of interest, are absolutely incentivized to create a narrative around the infrastructure that increases your chances of losing money. In fact, the infrastructure itself is self-perpetuating. Think about it like this. If you own that company where you've got 10,000 clients and 9,000 always lose money, and you're spending 30 to 50% of your money to replace them every month, the ones that are closing down, what happens when a new guy opens their account? Well, you know you've only got 90 days to rape him. So what do? Do you wait 90 days? No, you get on with it. You do it as quickly as possible before he disappears. You've only got 90 days to take the money and take the ownership of that money from his account to your account.
Right.
So it becomes self-perpetuating. It's a very negative feedback loop. So they're very, very heavily incentivized to make you believe in short-term trading and to trade in the biggest size possible. So they can make the 4 revenue streams: spread, commission, financing turn, OTC gain.
So you see, it is very important that you guys understand that the reason why sometimes you are going to be told that, hey, you don't need to trade, you don't need to trade more often, trade less, risk less. All these things is not just so that the person advising you will stop you from making money fast. There is a conflict of interest, and there is actually some advantages behind these advices. Does that make sense? It's very important that we understand that. All right. So this video we are watching here is an amazing video.
So write them down.
Let's move on.
Make sure you don't forget them. This is how the industry works. Volume and size incentives, spread and com. Third-party financing with a turn, and OTC gain. And this is what the industry looks like. This is what the trading industry looks like, the infrastructure. On the left-hand side, we've got
I want you to really pay attention to this part of the industry, right? We had an investment bank, retail broker, trading educator, retail trader, and the exchange. Pay attention to this part very well, okay?
Exchanges and investment banks. And everything to the right of that is retail brokers, trading educators, retail traders. We've put a few labels under each. So the investment bank, what are they doing? They're providing the credit facility and clearing to the brokers. And that order flow goes through them electronically down to the exchanges and trades. It all happens within less than seconds. What's the retail broker doing? Well, the retail broker, if we skip the educator for a second, the retail broker is providing the access, so platform and software, financing, leverage, and liquidity. Now that's important because without the brokers, you wouldn't have liquidity. So that's the positive that retail brokers provide to retail traders. You can access liquidity that you wouldn't get anywhere else as a retail trader. So what does that tell you? It's a necessary evil to use retail brokerage platforms as a retail trader. You have to use them. We'll come back to that later. But what type of education do you get from brokers? Well, there's an incentive. There's a conflict of interest. You're not going to get education that helps you make money. You're going to get education that makes you behave like a monkey. Press the button as many times as possible per day until you blow up. And it'll be wrapped up in some sort of strategy.
So you see a lot of people are pushing the agenda, you know, he is the GOAT, he is the best, they are all agendas, guys, just to push you to make decisions over and over, because it's not about the quantity of the trades, it's about the quality. Nobody is saying that you cannot make money from trading, but the perspective and the narrative that has been sold is why a lot of 90% of retail traders are losing money.
Usually a technical analysis strategy, very short term, less than a day, in hours, in minutes. Follow this line on a chart. Every time this line crosses this line from below, buy. Every time this line crosses this line from above, sell. Signals. Very typical. You're not going to get education that works. So they're providing this to the retail trader. What have we called the retail trader? Dumb money. Why? Because they believe everything that the broker tells them.
So now if you have been asking yourself the difference between smart money and dumb money, there you have it. So the dumb money is any money invested by, the smart money is any money invested by the investment banks, these big players, and then the dumb money is any money invested by a retail trader. And you might say, hey, Cliff, but there are other retail traders such as yourself and other retail traders that maybe are not trading in a dumb way. Yeah, but the majority of the numbers is trading dumb money. So that is why it says over there dumb money.
And on the left-hand side, we've got the smart money, investment bank traders on prop desks. Why do we call them smart money? Because they believe nothing that anybody tells them in the market who has conflict of interest. We'll go into more detail on that later. They do the opposite of the dumb money. What's the retail trader paying? Spread and commission. What are they providing? They're providing the demand for the financing, the demand for the false narrative, and the demand for losing trades. So they're providing the liquidity for all of those conflicts of interest. And we have the acronym there, COI. So if you see that in the presentation later, the acronym COI, conflict of interest. And the education is a false narrative.
Yeah.
We're going to go into a little bit more detail on how this works.
So what basically that means is that to make retail traders believe in short-term trading. You see, I already told you guys this back in the days, and I said, every single poor person has a short-term gains mindset. Like, I want to make money now. I need to make money now. That is a way that you are being hooked to the agenda or that false narrative that is always being pushed. So there is a smart money and truly there is a dumb money. But learning smart money concepts does not give you the mindset of a smart money. No, smart money is you understanding what these guys are doing at the end and how you play a part of it and how you want to extract yourself out of this monopolistic, games and be at the right side, taking your time, executing the trades step by step. It is very important.
Works in terms of the OTC game and how all of the conflicts of interest.
I'm going to pause this video for a second, and we're going to talk about we're gonna move to this part of the session here, and after that I'll be done, and you guys can watch this video on your own. It's 2 hours video. Discipline yourself and watch this video. All right.
More on this later, but smart money and dumb money. This is why we labeled smart money on the professional side, investment banks, prop desks, dumb money on the right-hand side as the retail traders. Smart money understand how the financial markets work. They understand conflict of interest. It's professional trading 101. It's the stuff you get taught in your first couple of months at Goldman Sachs or any firm that's good. They avoid trading in the way that other participants in the market who have conflict of interest want them to. They avoid it. And they do everything in the opposite way to the way retail traders do it. What do dumb money do? Believe everything they're told and rely on the infrastructure provided to them by financial market participants with conflict of interest. Believe that the infrastructure has been built for their benefit when it's actually been built for the opposite purpose. They trade in the way that they're told to trade. and they do everything in the opposite way to the way professional traders do it. But there's a catch. We talked about it earlier with the non-farm payrolls example. That's very typical. Smart money requires dumb money to exist. Who's supplying the credit facility? The investment banks. Who's the perfect broker? The one that peddles the narrative. Who's the perfect client? The client that believes the narrative.
So as you guys can see, listen, you can go ahead and watch this video after that I'm done. I just decided that a lot of people have not seen this video. We have currently like plus 11 million online active traders. And a lot of people are still believing false narrative. A lot of people are still believing in their own ideas and what they are. The group guy in the Telegram channel told them the ad they came across on Instagram or on Facebook, whatever one not. You see, in this industry, it is not about the guy that is flashing money around on Instagram, the guy that is riding them cars, the guy with the tattoos. That is not what trading is really about. The lifestyle of a trader is something we don't talk about. Trading is different as people think. It involves you putting the effort to learn, to understand, the realities of trading, because the reality is everything. Because you have to understand that before you join this industry, there are already infrastructures there to make sure that you lose money. The conflict of interest already exists. There is already a group of people that needs to pump in money for the market makers to make money. These guys knows what they are doing. They are not just scratching their head wondering, how can we make money next month? They know that, okay, from this system to that system to that system to that system, all we need is for people to do exactly just this. And then we get the money, from them. I'm going to put the link to this video in the description. Please do want to watch this video. It's 2 hours. Discipline yourself and watch this video. Please don't forget to subscribe, to like this video, and to share it. All right. Have an amazing day. God bless you, and bye-bye.